Loan constant is a financial term somewhat related to cap rates and cash on cash in that it indicates on a percentage basis the cash return to the lender relative to the outstanding loan balance. Constant basically tells us how much principal and interest is being paid back to the lender divided by the loan amount. Let's take a look at the formula and then I'll run you through a couple examples. Loan constant, or K as it's abbreviated, is simply the annual debt service divided by the loan balance. Let's take a look at an example. Imagine we have a $1 million loan at, say, 6% per year, amortized over 30 years. In this case, our annual debt service would be approximately $72,000 a year. Divided by $1 million, that comes to a constant of 7.2%. If that same loan were amortized over just, say, 25 years, then our annual debt service would be about $77,000, or a 7.7 constant. And of course, if the interest rate went up to, say, 7% over 25 years, then our debt service would be in the $84,000 range, or an 8.4% constant. So the lender's return, cash on cash return to the lender, changes depending on the terms of the loan that is written. Lenders that want to recoup cash more quickly can charge a higher interest rate or shorten their amortization in order to do so. This has been a quick overview of loan constants, and thank you for watching.